All right, so I want to move off here to Recession Watch 2024 or 2025. That'll be the Recession Watch 2025. I'll get a nice little banner and dramatic music to play because this is a story that's going to be evolving over the next year or so. Um, if I remember correctly, like you're not in the we should really be bracing for recession uh, within the next 6 months. Like that's not what you're looking at, right? Because I'm not seeing that in the data either specifically.
Yeah, I'm holding a neutral stance on this. I think the data could be told both ways, and while we are seeing a cooling of economic data from a jobs perspective and a GDP growth perspective, it's not so bad that we need to start raising alarm bells here. I think we're at a point in which people are literally having to like invent indicators like the SOM rule in order to say, oh, a recession is inbound here because we're so convinced that we must be nearing a recession. But again, even from a technical perspective, we want to see a rise in unemployment and 2 down GDP quarters before it's even considered a technical recession. And quarter after quarter, we've posted growth in the economy from a GDP perspective. And at what are we at? 4.2% unemployment in the United States. That's effectively full employment. So these primary indicators for economic strength are still pointing to a strong economy, even though the long-term data, as we look at, the last, roughly 1 year to 1.5 years of data, are starting to pull back a little bit. It's not so bad that it's a concern. To recap,
I find it so interesting because uh, the recession is a contraction within the productivity of the nation, and there's a case to be made that what is it like GDP is being made up of like 40% government spending, something like that, some high number of government spending that's happening that's propping up GDP. And then some people go, well, then that's a sign that the real productivity of the nation is much lower and we're in a recessionary territory. But if you actually go by that number, we've been in recession 10 years. And if that's the case, well, then we got to have different words here to describe what we're talking about. For us who are in markets, what we have to think about is the liquidity, the capital, and the ebbs and flows, right? If we're talking about whether some group of individuals might lose their jobs in a particular industry, okay, if that's that's where you're at, that's what you're going to be paying attention to. And so, if I was like a hiring manager at some factory, okay, I'd have completely different considerations, which I understand here. So, for example, just to show the not this one, let's go with. Okay, so we have. So in the background here, you're seeing the chart. This is the ISM, and so the ISM, which basically a diffusion index that tracks the expectations of the production industry of a nation, especially the United States. It's what they're expecting. These are all their expectations, and the expectation is that we're headed towards a contraction phase, a recessionary phase. But we are at the lows of this cycle here, right? So even if we go down a little bit further, it's when we're up at the top of these peaks that it's the real danger, right? That sort of cliff down the other side. But we've been sort of prepared for a recession. Like you've been hearing this along with me for the last a year and a half, maybe even longer if you're hearing the whispers. Recession's around the corner. Recession's around the corner. And so you really need something to come as a surprise for it to really hit markets really hard, something big. And we're getting news here that China, the bond market is being the yields are dropping. We're seeing yields drop dramatically in the United States as well. But it's not off a cliff. It's this trend that we can actually see. So
Mhm.
we're getting it. There's not going to be overhiring happening now that they're going to have to roll back over the next year. There's not this euphoria that's happening with at the top of markets where people are overspending and over traveling and all that sort of thing, and new loans are being created. We're not getting that. And so what I'm actually seeing is that these signs of some weakening within some of these growth signals are the reasons why the Fed has decided, okay, we're going to cut, right? They're not waiting for some big crash to happen. They're like, okay, we're going to start easing now in order to help support markets. And that's bing, 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 bing. That's liquidity coming in, which is what we want as market participants. And so people are expecting to see the recession happen within the charts.
Mm-hmm.
And until some big catalyst comes, that some black swan thing that we're not seeing, I don't know how you can actually prepare for that, because nothing is saying that should happen. We might get a little bit of slowdown, right, headed into October. Hell, if we drop 10% in equities, fine. But we just saw Nvidia drop, what was it, significantly over like a week and a half, and then rebound. Amazon did the same thing. Bitcoin is up from its lows. I think liquidity is showing that things are going to be fine, if not a rip roaring over the next year. Now, sorry, go ahead.
I was just going to say, I've been watching a lot of this full unfold for some time now. I have another chart that I use for this, just to kind of get a sense of where we'll see it coming. And I'll share this one real quick. So this is a breakdown of all the historical recessions and effectively the unemployment rate in relation to the S&P 500, right? And one of the things that I can say pretty definitively is that we tend to get a signal of drawdown in the market before the recession is even called. So if we're going to see any kind of signal about an inbound recession, it'll come in the form of a fairly large drawdown in the S&P 500, roughly 15 to 20% overall, as an early warning of a rise in unemployment and overall the call of a recession. Almost every instance in which this green bar represents every historical recession we've had in the past, you can usually see a decline in the market of roughly 15 to 20% or more before we've even called the recession. So the way I've personally always looked at it is, what are the markets telling us? As we're looking at today's data, we had this quick pullback in the S&P 500, which was that almost a 20% pullback. However, it wasn't enough to warrant any type of slowdown in overall growth. So I would argue that this run up since then has really come from the AI phase. And yes, we are starting to see a small increase in unemployment overall, but I think the markets will tell us a bit before I'm ready to call a recession personally. It'll always be the leading indicator.
Right. Are you using the GDP based recession indicator index from the Fed, or are you calculating those green bars in a different way?
The green bars come from an indicator that I found on TradingView called U.S. Recessions. I believe this was created by Chris M665, and I believe it is it's pulling the data from Fred, which is the US RECD ticker.
Perfect. Oh, interesting. I haven't seen this one before.
Yeah, so super helpful to kind of at least understand how do these metrics stack up. The one takeaway for me was the markets are the leading indicator.
Perfect. Yeah, so unemployment is like the nail in the coffin. It's at 4.2. It is ebbing up, totally understandable. But to me, it's all about uncertainty, and no one is surprised that unemployment is ticking up. The Powell is talking about it. We're seeing it within the numbers. We're not surprised that this is occurring. So until something shocks me, and plus, every other shock we've seen has been met with a rebound, drastic rebound in the markets to all-time highs, faster than ever before.
We've talked about it before in the past. If we have another COVID situation, how fast is that V-shaped recovery? Now, I'm not under the impression that we won't experience some kind of a drawdown in markets that lead to potentially a 10-year lost decade. Eventually, we'll have to face that. But I want to see some economic indicators that really kind of support that thesis. It will have to be long periods of GDP decline. It will have to be low corporate earnings or even declining corporate earnings over the broad swath of components in the S&P. Unemployment rates that are unusual for the period that we're in. But right now, things, balance sheets on equities look strong and healthy. It seems like forward guidance looks good. Unemployment is still full employment. I'm just not seeing it yet. Somebody convince me.
I don't even see a 10-year low coming anytime soon until the dollar is no longer the reserve currency, because we haven't had a long recession, right? They talk about the last one that happened is like the GFC, 2009, and they talk about it like that lasted a number of years, like a number of years before the markets are back up. But if you actually go back to the news articles of that time, they were talking about how it would be 2015 before the markets ever got back up to the levels it was at. And it wasn't. If you missed that 2009 low, you were laughed at the whole way back up. It did not take 10 years like it did in the dot-com crisis.
Right.
And that's because we figured out the QE. United States has the reserve currency, and it turned out the whole world needs dollars, and you can export dollars. You guys are not exporting TVs and cars and all that. You guys are exporting dollars, and that's what you're in. And it was a lack of dollars that was a problem, and you guys solved that problem, or to a great degree, for a number of years. So until the reserve status is gone, I am not looking for a 10-year recession.